I believe the stock market rally is just getting started, and I also believe that it's going to end up making the 2021 bull market look small. You see, over the past few trading days, there's been a new trend that's formed where the large cap tech companies, or the AI hot stocks, have actually been cooling off. A lot of people didn't believe that that was even possible. Now here we are. Today, the NASDAQ is flat, and the Russell 2000, so the small cap index, is up 3.5%. And this sort of outperformance actually started a week ago, last Wednesday. You can see it on the chart. And that's no happenstance. Last Wednesday, we got lower than expected CPI data. So lower than expected inflation data, which is very good news for the stocks that have been underperforming for years now. You see, it's no secret that small cap companies have felt pain from higher rates. Small cap companies have much more floating rate debt on their balance sheet. So anytime interest rates go higher, or they're set to move higher long-term or stay higher for longer, that's kind of a mantra at the Fed right now, it hurts these companies. But that means the opposite is also true. Anything that hurts the higher for longer mantra is going to dramatically benefit these small cap companies, because all of a sudden getting financing to grow the business or paying off the existing debt becomes so much easier if interest rates are set to come down. And personally, I think if you are bearish on the stock market right now, you're making a huge mistake. For years, there have been YouTubers that just talk about how everything's going to fall apart and the world is ending, and you're not going to make money in this bull market because the bull market's going to end. You know what? They've been wrong for 2 years straight now, and they have done a major disservice to the people that listen to them. And so let me walk you through this thesis. First of all, though, if you're new here or returning and not yet subscribed, please subscribe down below. We have one of the fastest growing stock market YouTube channels on this platform. I'm incredibly blessed, incredibly grateful for that. But let's talk about this. I'm going to start with this chart on the screen here. I'll give you 5 or 6 reasons that I believe this bull market is going to continue. And then at the end of this video, I'll actually give you 2 reasons, legit reasons, that might prove this theory of mine wrong. I'm going to be 100% transparent with you, but it starts with this: the federal funds rate and the business cycle. You can see it's not really a secret. Over the past couple of years, the federal funds rate has been increased to help tamper inflation, and it's done a great job at that. But a lot of people thought that this would end up hurting the economy and that our economy would go into recession. Well, they were wrong for numerous reasons I've talked about previously on this channel, but the point I want to make today is all that the Fed has done by raising rates now is they've given themselves room to cut rates if anything recessionary starts to pop up in our economy. That's what we call the Fed put, and it takes tremendous downside risk out of the equation for all investors, because the risk of recession is very, very minimal. It's minuscule when the Fed has the tools at its disposal to cut interest rates, loosen financial conditions, and add liquidity to the system. Historically, anytime the Federal Reserve has cut interest rates, it has worked. It has stimulated the economy, and that's simple Econ 101. So the Fed put us back. They can lower interest rates by up to 5% to stimulate the economy if recession signals start appearing. And although I personally disagree with the notion that we need to cut interest rates now, I believe the economy right now is extremely healthy. Sure, certain areas are weakening, but I just think they're normalizing to pre-pandemic levels. You know, we can have a weakening labor market without it being recessionary. We can have a weakening labor market and it just be normalizing. That's what I think is happening right now, but that's kind of besides the point. We can look at this chart here. Over the next 6 months, the market is pricing in 2 25 basis point rate cuts. You know, that's not going to make a whole lot of difference. I mean, that's 0.5%, not a big deal, but again, it's the notion that the Fed has the ability now to cut rates if they have to. The concern would be if right now the federal funds rate was at 0%, like it was, pre-pandemic, and all of a sudden something hit our economy and we didn't have room to cut rates to stimulate the economy. That would be a danger, but that's just not the case right now. We're not threatening to cut rates and send interest rates negative if something bad happens. We can keep rates positive and above zero, which is very, very healthy. We don't want negative interest rates. Could it happen eventually? Yes, but right now it is extremely unlikely. It's kind of a side note, but negative interest rates actually, it gets a little bit quirky because you borrow money from a bank and that bank, or technically the government, will actually pay you interest to take out a loan. I mean, that's completely backwards. It's happened in other economies in the world previously. But we don't want a giant economy like ours, the United States of America's economy, to enter that sort of situation, at least right now. But yeah, then we can look. I talked about over the next 6 months, over the next year, over the next 12 months, the markets are pricing in 5 25 basis point rate cuts. This is going to be stimulative to the economy. I think you are silly if you are bearish right now, just based on these facts alone. And if that's not good enough for you, let's look at all of the money in money market mutual funds earning risk-free return because interest rates are higher right now. You can get a risk-free 5% on your money by buying treasury bills or putting it into money market mutual funds. I've personally done this with some of my cash that's sitting on the sidelines. It's earning 5% risk-free. But you know what? If interest rates get cut and all of a sudden I'm not getting 5% or 4% on my money risk-free, all of a sudden it makes the outlook of investing in the stock market so much better. Because if risk-free yields come down, you have to go to the stock market to get decent return on your money. And right now, since 2023, you can see the amount of dollars in money market mutual funds alone, it's climbed through the roof. It's climbed through the ceiling. There are $6.14 trillion with a T, trillion dollars in money market mutual funds. Some of this money inevitably is going to come back to the stock market if and when interest rates are cut, and if and when the stock market does take a 5 to 10% dip. I started this video by saying I think the market rally is just beginning and it could end up making 2021's bull market look small. That's not me saying there's not going to be 5 to 10% corrections along the way. But as those corrections take place, there is so much money on the sidelines ready to buy up any dip that I don't see the risk of a major fallout being that high right now. I think the risk of that is low. And again, investing in the stock market, the first couple things I started with this video off with tells you the risk of investing in the stock market right now is low. And then you have this. This is a fact, whether you like him or not. Donald Trump is more than likely going to win the presidential election this November. You can look at any odds market out there, and Donald Trump is the heavy favorite at this point. As of today, the yield curve is the least inverted it has ever been, and it's trying to uninvert or correct itself back to where it should be or where it has been historically. You know, this is an indicator that bears have been pointing to for years now, saying anytime the yield curve has inverted, we've seen a recession. And that actually has been true historically, but today is so much different than any other time period in the past. You see, because of the great financial crisis and because of the great virus crisis, the Federal Reserve has learned how to play whack-a-mole with emergency liquidity facilities so extremely successfully well. That probably wasn't proper English, but you get the point. They've learned how to stimulate the economy on a dime and prevent any sort of credit crunch from becoming an economy-wide recession. The yield curve got it right. Again, we did see a financial crisis in our economy. Think back to March of, was it 2022, when Silicon Valley Bank and a few other regional banks were going under and were in trouble. That was the financial crisis that the inverted yield curve correctly predicted. But what's different today, again, is that the Federal Reserve contained that crisis because they've learned how to contain these crises as a result of the great virus crisis and the great financial crisis of 2007 and 2008. Now, I know there's at least one of you out there typing a comment right now, well, Rex, just wait, you're going to be wrong. Recessions don't take place until after the yield curve snaps back to reality and normalizes and the yield curve disinverts. Yeah, you can look at this chart and see that, yeah, typically that's the case. The yield curve inverts, and then a little while longer in the future, the recession actually takes place. So these recessions have taken place after the yield curve has disinverted. The reason I'm gonna say this on record, the reason this is not going to be the case today is because, again, historically, the reason that the yield curve has disinverted is because the Federal Reserve has had to cut rates extremely fast because of a crisis in the system, which makes the yield curve snap back to reality and normalize and disinvert. We don't have that risk right now. Sure, a black swan, there's always black swan risk out there, but for the most part, we don't have that risk right now. There's nothing in the system that's telling us the Federal Reserve is going to have to act extremely fast, cut rates, loosen financial conditions overnight, causing the yield curve to disinvert, and then thus, we end up seeing a recession. Because again, the Federal Reserve has shown that it has learned how to contain these crisis events and prevent them from becoming full-on recessions. So what the bond market is telling us about a potential Trump presidency is that the markets are anticipating stronger economic growth than they previously were. Stocks have also been up. You can see that in the Russell 2000. But the markets are also anticipating wider federal budget deficits. So it's not all sunshine and rainbows for a Trump presidency, at least based on what the markets are projecting. The bond market is counting on looser regulations, stronger economic growth, but also higher inflationary pressures, which is going to cause the long end of the curve to actually stay elevated. Because if we have higher inflationary pressures, the chances of extreme rate cuts taking place actually goes down. Because if inflation pressures are higher, it means that the Federal Reserve is going to have to stay higher for longer, theoretically, unless they want inflation to really run away from us, which they don't want to do that. So while the markets right now are pricing in some short-term interest rate cuts, they think that the federal funds rate is restrictive right now. I personally don't believe that, but it's not really up for me to decide. The markets are pricing in a few rate cuts over the short term, but over the long term, the markets are saying interest rates are going to stay at 3 to 4%, which I think is an appropriate level. Again, I don't think at 5% on the federal funds rate, we are restrictive. Historically, it would tell us that we are not restrictive. Historically, it would tell us that this is a normal interest rate for the economy. And we've proven it. We've proven it over the last couple of years. Economic growth has been extremely strong despite the federal funds rate being at 5%. Company earnings have been extremely strong despite the federal funds rate at 5%. We've proven that our economy and companies can perform tremendously with the federal funds rate at 5%. Now, I understand there's a lot of concern out there about the government's debt and the net interest outlays the government has on its debt to pay the interest rate on its debt. Well, we can look at the CBO, so the Congressional Budget Office, and their projections for the federal government's debt until 2054. So this is 30 years out from today? That's kind of crazy. Oh gosh, I'm going to be 54, 53 years old. Oh, that's old. Anyways, you can see that it's no secret. The Congressional Budget Office thinks that our federal deficit and our federal government debt is going to continue to grow higher and higher and higher every single year until 2054. But this isn't really anything new. The government has never, I shouldn't say never, there have been a few times in the past where they've had a balanced budget, but historically, it just doesn't happen. But what might actually be more scary is that assuming Trump wins the presidency, the CBO actually projects an additional $4 to $5 trillion added to the to deficit spending over the coming decade. So, you'd have to bump all of these light blue lines up, $4 or $5 trillion, which it sounds scary. I won't lie to you. It sounds scary. And then you can see we're just about a month away from the amount of interest being paid on the government's debt exceeding the amount of money we're spending on defense purposes. So like military spend, our interest on our debt is going to exceed that sometime in the next month. It's a scary thought. In fact, this year alone, we're going to spend more than $1 trillion trying to service our own debt. And really, I don't have an answer for this concern. We've operated just fine historically while the government debts continue to grow because we just print more money and inflate our debt away. But there's no way to really put lipstick on this pig, as they say. It is a concern of mine. It's important to realize that the CBO can also be wrong. They've been wrong historically. These are just projections. Trump's goal is to actually outgrow any additional deficit spend that might take place. It's possible. Nobody really knows what's going to happen. But yeah, this is something we're going to have to monitor over the coming decades. But the bottom line is we're probably just going to print money and inflate this debt away. My hedge against this is owning Bitcoin and owning Bitcoin mining stocks. And I think that's probably the best hedge you can get because it's a fact. Every single monetary system that's ever existed in history has eventually failed. The US dollar will eventually fail. I pray that it's not during my lifetime. But my safety net, my hedge on that is Bitcoin. Now, one of the major reasons that we haven't seen a recession is actually because of our parents, the baby boomers, who are all entering retirement age now. Maybe some of you watching this video you're technically a baby boomer. You guys are entering retirement age with a record $78.6 trillion of net worth. $78.6 trillion. Think about that. And how much money that is. $78.6 trillion of net worth. And that generation, the baby boomers, are retiring with an itch to spend. You know, the pandemic brought that out even more. You know, it made people realize, oh, life is short. I'm going to go travel. I'm going to go spend my money. I'm going to go pay for my family meal. And this isn't something I'm just pulling out of thin air. This is like legit. Baby boomers, they're spending money on hospitality, insurance, social services, restaurants. And those areas of our economy have had some of the strongest employment numbers. And there's a reason for it. So much money is being spent in those areas. Entertainment's another one of those areas. And this is a demographic thing that I'm sorry, if you're bearish on the stock market, you can't just ignore this. You can't ignore the net worth of a generation that is retiring with an itch to spend their money. And any money they don't spend, it's just going to be passed down to the next generation, which the next generation can use to pay off debt, to pay off credit cards, to if they want to spend it buying a new house. I mean, this is a lot of money that is going to prop up our economy. It has been propping up our economy. It's going to continue to do so for many, many, many years. And then one other reason I'll give you of why you're making a mistake, if you're bearish, in my opinion, is AI. You know, on this channel, I've called out this AI bubble. I think the euphoria is nuts. I think we are overhyping AI short term, but underhyping it long term. Now, it's just a fact, though, that AI already is showing us tremendous enhancements to productivity in our economy. And NVIDIA is one of those companies that benefits from it. But over time, if AI is legit, which I believe it is, we're already seeing benefits from it, it's going to be much more than just NVIDIA that benefits. It's going to be every business in the country, if not the world. And it's also going to be every consumer and worker in the world. Because if company profit margins go up and companies are earning more money, those companies historically have increased payrolls. They've dished out raises or bonuses. And that gives consumers more money in their pocket to spend. They call that discretionary income. Money after expenses that is up to you on how you want to spend it. This is a decades-long shift in productivity. I believe the 2020s are going to be a lot like the 1920s, where there's going to be huge enhancements to productivity and incomes and profit margins of both businesses and consumers. So to sum up all of this, I put out a tweet the other day. 1, the Fed put us back. They can lower interest rates by up to 5% to stimulate the economy if recession signals start appearing. 2, there is $6.14 trillion sitting in money market mutual funds. AI is early, already showing significant enhancements to economic productivity. Trump will likely be elected, and he doesn't think there's a proper limit on economic growth. And I'm sorry, I disagree with Trump here. There is a proper limit to economic growth, but everything Trump does is going to be with an emphasis on increasing economic growth, GDP growth. And he doesn't think there's a ceiling or a proper limit to that. You know, I wouldn't want to be bearish in that sort of environment. And then baby boomers are retiring with a record $78 trillion in net worth with an itch to spend. And people are bearish right now. It doesn't make much sense to me. So let's talk about the two things that do concern me right now. I've talked about the government's debt. That is concern. I'll actually give you 4 things that concern me moving forward. But I don't assign much likelihood to them hurting the markets short term or honestly over the next 12 to 24 months. It's the federal government's debt. I don't think that's going to be a problem for decades probably though. And honestly, it's not that hard to balance the budget. You raise taxes and you cut expenses. It's pretty simple. It's not that hard of a fix. Secondly, I've said it on my channel repeatedly, I think the market is headed towards a melt up. I think we're going to form a bubble in the stock market, and eventually that bubble will pop. I think that is the most likely outcome here, just based on these 5 bullet points here and everything else I've mentioned in this video. Euphoria is going to come back to the markets. This is why I think the 2021 bull market could look small by the end of this. So that's a concern, but again, that's not a concern we're going to have to deal with for the next, hopefully, 12 to 24 months, at least based on my estimate. Third, I assign some risk to geopolitical tensions rising, especially after the Trump assassination attempt, which, by the way, there's no room for that in our country at all, and I pray for the families of those that died as well as those that were injured. I pray for peace every day for our country and for the world. I just wish we could all get along and be more united and unified. But with that out of the way, I do assign some risk to this. But in the end, we can look at this chart that I have on the screen here. Any geopolitical crisis that has reared its ugly head, I'll say, it's ultimately resulted in, maybe the stock market falls for a little bit. But the bull market, this chart goes back to 1920. All the market's ever done, despite what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. There's 13 crisis events on this, geopolitical crises on this chart that have happened since 1920. And there's been many more that aren't listed on this chart. Throughout all of it, no matter how bad it looked short term, the market's gone up in a straight line. And that's what you have to remember. Long-term, things are going to be okay. In fact, if we look at 9/11, the markets fell for a few months and then all of a sudden picked right back up. The great financial crisis, markets fell for a little bit, then picked right back up. When Russia invaded Ukraine, that was the top of the market, but we're already back at all-time highs now. Hamas attacking Israel was another short-term downwards move in the stock market, but we're already back to all-time highs. So short term, this is probably the most likely thing that could happen. Geopolitical tensions continue to rise. The wars overseas continue to escalate. And that could be a short term risk to our economy and the stock market. But long term, again, this doesn't really concern me. But lastly, it's this nothing to fear except nothing to fear. You see, anytime the markets look really good and there's really nothing in the system you can see hurting the stock market short term, it's generally when the markets are ripe for something unexpected to happen. And we can see this represented by bull-to-bear ratios. Right now, the bull-to-bear ratio is 3.5. That is historically very high. The average over time is 1.91. So what that means is historically there's 1.9 bulls to every bear. You can't have 9/10 of a person, but you get the point. Right now, there are 3.5 bulls to every bear. This chart shows 62.7% bulls and only 17.9% bears. It's just all of these surveys and bull-bear ratios that kind of concern me. It means that there aren't very many bears that we can flip back into the bullish camp, because no matter what, you guys have seen it on YouTube and in social media and even on CNBC, there are just people out there that are perma-bears. They are always bearish, which makes zero sense when you look at what the stock market has done for the past 200 years. And they are permanently bearish on the stock market. It makes no sense. They've cost themselves so much money and their viewers so much money, and maybe even their clients so much money. It makes no sense to be bearish, permanently bearish, I should say. But yeah, the remaining bears right now are those perma-bears that you're likely never going to get into the bullish camp. So we're running out of people to turn into bulls. But again, I can go back to I think it's this chart. No, let me find it. Money market mutual funds. Despite there not being very many bears left to turn into the bullish camp, bulls like myself, like I said earlier, I still have money sitting on the sidelines earning risk-free yield at 5%. And I'm bullish, and that's extra cash that I can and likely will in the future pull out of risk-free yields and plow it back into the stock market. So what do I think the playbook is now? Well, you've heard me say I think we're headed towards a market melt-up and a market bubble that will eventually pop 12 to 24 months down the road, if not longer. In fact, if I had to guess, under the Trump presidency, we're all going to make a lot of money over a short amount of time, but whoever the president is that fills in for Trump after his next 4 years, I think they're going to have to deal with something falling out of the stock market and maybe the economy as well. But that's a long ways down the road. Again, I think we will see 5 to 10% corrections along the way, but ultimately what's going to happen, and this happens every bull market, investors start to look for more and more and more and more risk because all of a sudden the 6, 7, 8, 9% returns aren't good enough. They see everybody else making 20, 30, 40% in Bitcoin or some penny stock out there, and they go more risk on. And that's what eventually resets the bull market is people get way over levered. They get way too greedy. They take on margin to chase returns, and something happens, and all of that money gets liquidated, and that's when you see bear markets take place. I mean, just look at 2022. That's exactly what happened. I think it's going to happen again, maybe even on a bigger scale, though. But like I've been saying for a while, I think you want to be in small cap stocks. You want to be overweight small cap stocks. Again, I am doing my best to research as many of these small companies as I can. You heard me earlier say that there's a lot of floating rate debt in the Russell 2000. Very, very true. In fact, of the debt outstanding, I have it in my notes here, of the debt outstanding in the Russell 2000, 45% of it is floating rate or variable rate versus only 9% in the S&P 500. That's why the S&P 500 has not been hurt as much as the small caps have. But there's tremendous opportunity in small caps, I believe, because half of the debt in the Russell 2000 is held amongst 10% of the constituents. So out of the 2,000 companies, 200 of those companies hold half of the debt. And you stack on the fact that 33% of the companies in the Russell 2000 have net cash. That's when you take the cash balance of a company and subtract the company's liabilities and you have a positive number. That's net cash. 33% of the companies in the Russell 2000 have net cash versus only 13% in the S&P 500. So while certainly there are small cap companies that have rightly been beat up in this market, it hasn't been fair to all 2,000 of the constituents in the Russell 2000 or even the micro caps if you want to get that granular. A lot of very healthy companies with healthy balance sheets and companies that are on the verge of profitability have been, or they're already profitable, I should say, have been beat up alongside this entire group of small companies just because they are a small cap company. There's tremendous opportunity. I'm doing my best to look into as many small cap companies as I can. I'm putting together an A list of companies. I have 3 on that list right now. I'm looking at it right now. When I have this list completed, I'll send it out to my paid monthly members. I'm going to throw money at these companies. I think there's tremendous opportunity. If you want access to my membership, I'm entirely self-funded, so your support means a lot to me, and I'm 100% confident in delivering you alpha in the stock market. And if you don't find value, I have a 100% refund policy, and I've yet to have to refund anybody, so let that speak for itself. But yeah, with that, I'm going to end this video here. Let me know your thoughts on the state of the current stock market and where we're headed. You don't have to agree with me. I think that's the beauty of the internet and the beauty of the stock market is I actually hope most people disagree with me because in the stock market, it's one of the few places where if you have the contrarian opinion or the unpopular opinion, you're actually usually the one that's correct. So I hope a lot of people disagree with me, but if you support me or disagree, let me know in the comments section below. And again, if you're new here or returning tonight, subscribe. Please subscribe. Helps my channel out tremendously. Of that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.